Let me now bring on board Mr. Bhat, Managing Director with Dalton Capital Advisors. Mr. Bhat, morning. Thank you for joining us. Mr. Bhat, there's no mystery in why Indian markets are correcting. Globally, things are sticky. Locally, it's the rupee factor and earnings have been poor. But do you think this is time to buy fear, because now Indian markets are looking attractive and individual stocks are looking rather mouth-watering?
Well, I don't think there's any argument on the attractiveness of the Indian market from a valuation viewpoint. I think it is the other macro factors that are probably bringing some doubt into whether people really want to invest in India. Primarily, of course, we have local factors like the rupee's weakness. Then we have the fiscal deficit, the current account deficit. All these are known factors. Plus, of course, lack of reform momentum, lack of policy initiatives. Plus, also you have, as far as FIIs are concerned, you have, of course, rupee is a very important issue for FIIs because they lost quite some money over the last few months just by keeping quiet. Plus the uncertainty in Europe about whether Greek is going to be a part of the euro or not, and also how they're finally going to play this end game as far as euro is concerned, and the consequent uncertainty about the appetite for risk. I think all these things are making Indian markets not all that hot as far as FIIs are concerned. In addition, you have this the nebulous sort of taxation structure in India as far as FIIs are concerned. Nobody knows what exactly is going to be the incidence of tax as far as investing in India is concerned. All these things have come together and made India a bit less attractive than otherwise it would have been. In addition, as far as the domestic players are concerned, you have one of the biggest players, LIC, which is now only busy buying PSU stocks, and therefore, consequently, hopefully, must be actually selling the other stocks that they have. So therefore, I mean, that has been rendered sort of ineffective as far as the Indian market is concerned, and domestic mutual funds are sort of losing money in their equity funds. So the sum and substance is that there is a remarkable lack of interest as far as the Indian market is concerned, even though on a valuation viewpoint it looks attractive.
So, Mr. Bhat, what is it that we're staring at? While it's a given that, currency has really hurt the sentiment badly, but do you think inflows can resume once perhaps the RBI actually intervenes and the rupee stabilizes, or do you think it's going to continue to be a grim situation, considering it's not just domestic factors, but what is transpiring in the Western world, which also is sort of dictating the FII mood right now?
Well, I think the FII mood is quite, is of course dictated partly by the risk appetite in the global markets. That is probably something on which India has little control over. But as far as the domestic issues are concerned, I think certainly the authorities can do something about it. Like, say, for example, the step function sort of fall in the rupee is something that could have been managed much better. All players seem to think so. The fact is that we have close to $300 billion of reserves, and we certainly have the ammunition to ensure that there is a stable even if there is a correction that is required on the rupee, that could have been managed much better and in a much more sort of stable manner. And added to that is the feel that nothing is statements to the effect that we really don't have the ammunition. And I think there has to be a perspective about what the government is going to do in terms of financing this trade imbalance of something like about $185–200 billion, because finally the fact is that something like about $30–40 billion of foreign investments are required every year in order to ensure that we meet that gap, and we need to be bringing in policies which attract foreign investments. On the contrary, we have been doing exactly the opposite from the time the budget was presented, even though RBI, to its credit, has been saying that attracting foreign investments is very important to sustain the sort of trade imbalance that we have. So I think there is, the authorities at Delhi and Bombay seem to be working at cross purposes, and that there has got to be some sort of coordinated action there if we need to see some stability in the rupee.
Mr. Bhat, is there merit in being a contra buyer in BHEL and L&T? These are stocks which may see a lot of pain in the near term, but eventually if the capex cycles revive, BHEL and L&T are the first two stocks which will bounce back.
Well, I think that's a good argument. The point is that the capex cycle to revive, entrepreneurs have to take those decisions to invest in new projects. and that requires some sort of confidence in the way the economic affairs are conducted. So I think there is that lack of confidence among entrepreneurs, because especially over the last, say, 2 or 3 years, the entrepreneurs who have invested in new projects have hit roadblocks, and they are not able to even complete the projects. So therefore, it's very unlikely that entrepreneurs are going the whole hog in terms of announcing and planning new projects. So only after planning and after a certain stage of certain amount of groundwork is done, you will get orders for capital goods. So therefore, there is a good reason why these stocks that you mentioned are quoting at those levels, because the outlook for new orders does not seem to be very good.
Okay, Maruti is the biggest drag on expected lines, 1122 for Maruti, down about 3% for the day. Mr. Bhat, do you think it's a problem of plenty for Maruti? First, there is competition in the passenger car market. B, they are exposed to the currency fluctuations. C, there is a visible preference towards diesel cars, and Maruti has a minuscule market share in the diesel car market.
Well, I think all those issues that you highlighted are certainly relevant, but the fact is that they have been able to sense the demands of the market quite well over the last several years, and have been catering to those demands quite well. So there is, of course, there is probably an interlude between the hike in petroleum prices and hike in diesel prices. But diesel prices will also probably be hiked over the next few days, and then it will probably look like as if it's an even sort of playground. So well, all the problems that you have highlighted are important, but I think valuation captures quite a lot of these problems.
Mr. Bhat, what about earnings, and how have you mapped them so far, considering we're pretty much at the tail end of earnings? And do you think the pain is out of the system in the Q4 and this was indeed the worst we've seen, or do you think there's worse to come?
Well, if there is serious problems in Europe and the problems there remain unsolved for the next several months, which is a very likely outcome, I think there could be certain serious problems as far as India's exports are concerned, because finally Europe is a very important trading partner, and if there is no growth there, in fact there is recession there, it will certainly translate into pressure on exports, despite the fact that the rupee has depreciated quite a lot. It is not as if we can depreciate and keep exporting. There has to be demand. So I think there are very serious issues there. It is not as if we have seen the nadir of earnings growth. There could be further pain, because you should also accept the fact that with the sort of borrowing, the foreign currency borrowing that corporate India has, if all those borrowings are mark to market, there is a further chunk of loss that needs to be accounted for, which of course, because of a change in the accounting rules, we are not exactly passing it to the P&L account. But the fact is that whenever you have to repay these loans, you will have to pay much more in terms of rupees. So these losses have to be accepted over time. So I think we are going through a stage where there is a lot of uncertainty. It is not as if we have reached a stage of inflection where we have had the worst and from here it has got to be growth all the way. It is not so. It could be a V with more of a U sort of a curve. So therefore I think we are at the bottom end of the U curve, and we have to still wait and see whether the bottom keeps extending further.
Mr. Bhat, Indian currency is at an all-time low, but Indian markets are still 4-5% away from the December low. Do you think it's a matter of time that Indian markets either will retest the December lows or even overshoot beyond the December lows?
Well, for the most important players in the market, which are FIIs, in dollar terms, the market is well below the December lows. So therefore, it is not as if they are still waiting for further lows. But I think 4600 or thereabouts, which was the December low, I think that is a very important sort of support for the market. Unless something dramatic happens in Europe, or unless there is further some other huge problem that comes out of the woodworks, as it were, in India, I think that is a very important support. That would be broken only if there's something that is unthinkable as of today happens. Till then, I think 4600 is a reasonably good support level. So
if we go to 4600, would you like to use that as an opportunity to buy more stocks, and at 4600 in your India portfolio, would you be 80-90% invested?
I think that's a very good level at which one should review the situation and see what the prospects of a change in sort of sentiment and momentum is likely to be, given the information at that stage. But looking at it from now, it looks like as if 4,600 is a level at which people could think in terms of investing.
So, Mr. Bhat, what do you think is going to be the biggest drag on the markets from here onwards? We've seen banks underperforming. We've seen autos really taking a whack. Do you think it's going to be an across-the-board fall, or would it be sector-specific?
It will certainly be sector-specific, because all said and done, if you really see the private sector banks in the March quarter have done reasonably well. It is the public sector banks which have had a very bad sort of result season. Private sector banks have done well. All said and done, the demand for sort of two-wheelers has been quite robust, even during the 2008 sort of interlude. So therefore, I mean, there are pockets within the market which seem to be much more resilient to the slowdown in the economy than many others. I mean, it is basically the capital goods, the infrastructure sector. These are the ones, and sectors that are related to them. They are the ones which have taken the brunt, and they might continue to take the brunt for some more time unless there's a sudden change in policy direction.
Mr. Bhat, now there is a reason why consumer stocks are outperforming. I guess there are lack of options. But at these levels, when inflation is high, high interest rates are eating into savings, and salary levels have been static. Do you think it makes sense to buy consumer names?
See, most institutional investors get money to invest in stocks, so therefore they don't have the luxury of keeping themselves largely in cash. They have to invest in stocks. So therefore, during times such as these, with the levels of uncertainty are very high, they need to be parking these monies that they have raised somewhere. And all said and done, there is certainly a lack of investment demand in India, but consumers have been doing very well in terms of their purchases. So the consumer demand has been good. So therefore, the natural thing for institutional investors to be doing is to park money in things like FMCG, where the demand is reasonably good. Even though, of course, the valuation argument is certainly against investing there. But that is a herd mentality, because bulk of the money that is available for investment in the market is managed by institutions which have this constraint.